around a series of key discussion topics. We will firstly have some opening remarks by the chair of the Disaster Risk Reduction Working Group, Kamal Kishore, followed by a presentation by Dr. Nicola Ranger from Oxford University, and then 4 mini discussions, including in total 16 participants. So bear with us, and indeed I hope that all of our 16 participants are in the room, but we'll divide that into 4 sections, and I'll introduce each of the participants as we go along the session. So without further ado, let me hand over to you, Kamal, for your opening remarks.
Thank you, Alex. But before I start speaking, I have an observation that we have gone back and, including me, sat in our original seats of the formal meeting. So I would urge you to sort of come back a little bit closer so that, there are so many seats vacant here, so that we can have a real feel of a round table, as opposed to, Ila, maybe you can sit right here so that we can see you and hear you. So ever since we started working on disaster risk reduction within the G20 frame, this issue that we have to bring in private sector into the conversation has been coming up again and again. So there are many shades to that expression of interest to engage with the private sector, ranging from making the private investments themselves more resilient to attracting private investment into disaster risk reduction. So we thought at this meeting here in Mumbai, we should have a round table. So I will divide my remarks in 2 parts. First, I want to just say a few words about what is the landscape that I see in terms of the kinds of work, kinds of engagement that private sector is having on disaster risk reduction issues. And second, I will have 3 questions as working group chair that I would like to hear private sector's answer on. So the first thing is that, this whole notion of private sector involvement in disaster risk reduction is not new. We've been talking about it for at least 2 decades. There are numerous initiatives. You have Japan Bozai Forum, which meets every year at least. You have Coalition for Climate Resilient Investments, a private sector initiative launched in 2019. You have ADPC-led I Prepare. You have from 2011 onwards, UNDRR Arise Network. So there are numerous conversations, engagement with private sector. They all fall in 3 categories. The first and most classic category is what in India we call CSR, a corporate social responsibility. You're corporates, you make profit, so you give a certain share of your profit for social good and primarily for response, efficient, effective, timely response. And the second type is where private sector is providing services, analytical tools. If you go to Japan Bozai Forum, you will see manufacturers of instrumentation for measuring earthquakes, sensing earthquakes. You will see people providing risk analytics, people doing drone services. So there are people who can provide services, commercial services, to assist in risk reduction. And the third, more sophisticated one is, how does private sector itself become more resilient to physical disaster and climate risk? How does it do business itself differently so that the risk is managed better? So these are the 3 things, but for this conversation, we want to focus on the third one more than the first 2. The first 2, as corporate social responsibility and commercial service providers, you have people providing risk management services, analytics, images, drone services. We don't want to emphasize so much on the first 2, but more on the third one. So the answers that I would look for, you have big business houses from Mumbai in the room today. The first question is, how are you managing physical disaster and climate risks? Particularly, how are you going to deal with uncertainty about what the future looks like in terms of the climate signal, in terms of the hazard scenarios interacting with rapidly changing urban systems, rapidly changing socioeconomic systems. How are you dealing with risk and uncertainty in the 21st century? And there are two shades to that. One is that there is a changing risk landscape just in terms of the everyday risk. You know, if you are a big manufacturer, you know that year on year, the number of heat wave days are increasing. That has impact on your productivity. And you don't know what the future is going to look like, you know, in different locations. How are you dealing with the everyday risk, which is changing? And also, how are you dealing with the risk and uncertainty associated with low-frequency, high-impact events? You know, you have big investments in coastal areas. You know, how are you preparing for a 1 in 500-year tsunami, or an extreme rainfall event, or an extreme cyclonic event, you know, that exceeds design speeds, wind speeds? So that's my first question. My second question is, yesterday when we had the discussion on finance, somebody said that the future is green, in the sense that there is a lot of demand for investment in climate change mitigation, clean energy. Can we have something similar? How can we create a market for investment in climate change adaptation and disaster risk reduction? How does it become more attractive for private sector to invest in activities that take us from disaster risk to disaster resilience? How do we create a market for that? You know, what is it that needs to happen? And my third and final question is, what are the expectations of the public sector, public institutions, in terms of creating an enabling environment so that it becomes more attractive to invest in disaster risk reduction, so that you invest in disaster risk reduction for the sustainability, for resilience of your own operations, but also for the larger societal goods. So I am quite looking forward to this conversation. I think some fresh ideas will definitely come up, and we'll latch on to those and integrate them into the work of the working group to the extent we can. Thank you very much. And I am not chairing this, so I'm going to leave from here and move around a little bit. Thank you.
Thank you very much, Kamal. You've set a very high bar for this session, and I hope that we will be able to answer all three questions when we finish. So we'll make sure we come back to you to get your judgment on this. Let's start by inviting Dr. Nicola Ranger to give us a presentation on the opportunities and dividends for the private sector to start aligning finance to resilience and risk reduction. Dr. Ranger is a program leader and senior research fellow, Resilience and International Development at the Environmental Change Institute at the University of Oxford. I don't know if you can, here she is, hello. The floor is yours.
Thank you very much. Well, it's an absolute pleasure to be with you today, and I'm sorry that I cannot be there in person. Firstly, let me thank you very warmly for this kind invitation to be with you today. It's a real honor to be able to speak to you all. So, as was introduced, I'm based at the University of Oxford, and I'm one of the leaders at the Environmental Change Institute, where I particularly focus on the topic of how do we mobilize investment in adaptation, and how do we build resilience as a society. If I might ask you to go on to the next slide. So I'm just going to give it a couple of thoughts to help motivate some of the discussion. And I'm going to frame this very much in terms of opportunity. I think when we talk about resilient infrastructure, we talk about the challenges, the growing risk from climate change, the issues around data. I want to reframe the discussion at the outset towards this being an opportunity. So yes, we've heard in the introduction that we do have this infrastructure financing gap. Numbers on this vary, but there are numbers around sort of 3.9 trillion a year is needed in terms of investment in adapting infrastructure, both mitigating and adapting infrastructure over the next decades. But really, that's an opportunity. So, globally, there are well over 100 trillion in assets under management, and investors are seeking good investment opportunities. So I think we need to frame this as an opportunity, and as we heard in the introduction, think about, well, how do we make this work? How do we mobilize this finance, these huge global pools of capital, into this urgent societal need? If we go to the next slide, please. And why do we talk about this aligning finance with resilience? So what do I mean there? I think, again, we often focus on we need to mobilize new finance. There's a gap and we need to mobilize that. Actually, I think it's about looking at how we can better align investment overall with resilience goals. And we've seen huge action on this on the mitigation side. So within the Paris Agreement, there's a clear commitment to, under Article 2.1c, to align finance with greenhouse gas emissions reductions. We see, organizations like GFANZ committing to align their finance with mitigation. Actually, the Paris Agreement also says climate resilient development. So that's in there, but we're not operationalizing that. And I think if we can look at similar tools to align global financial flows, which, as I've said here, for infrastructure, 2.7 trillion a year is already going into infrastructure, which is 60 times greater than all adaptation finance. So all tracked adaptation finance, around sort of 50 billion a year. So really we need to focus on how do we get this existing infrastructure investment to be resilient? And that's really what I see as the key opportunity here, as well as to mobilize more investment into infrastructure. If we go to the next slide, please. And obviously there are huge societal benefits in this, as well as private benefits, and actually a really urgent need, because these decisions that are made in infrastructure today, this 2.7 trillion, if it's not made resilient, then it's potentially locking in greater risk for decades, and greater risks, destruction of natural ecosystems, etc. So this is a real urgent need that goes beyond just the immediate infrastructure need. If we go to the next slide, please. So, the comment was made around how finance, the adaptation financing gap, and how action on adaptation finance is still lagging behind mitigation. And, can we build these markets for adaptation? I think the key thing there, there's a lot of, well-documented examples of how one would do that. But the key thing there is we need to either, one, make it pay, so ensure that investors are getting returns from investing in resilient infrastructure, or two, regulate it. They're the basic two options. And in terms of the making it pay, what I think where there's a real opportunity is looking at how we can monetize the societal benefits of these investments. So here we've got some analysis that we did at Oxford in collaboration with the World Bank, where we actually looked at the whole of Southeast Asia and we looked for all of the key infrastructure, critical infrastructure. What were the benefits to the infrastructure investor themselves of investing in resilience? And then what were the wider societal benefits of investing in resilience? And you can see this tool, it's available openly, and actually click on the different individual infrastructure. And what you can see is those societal benefits are several times greater than the benefits that the private investor is finding from making that investment, which is very natural. But if we can find a way to monetize those through effectively designed markets, then we can really help capture this opportunity to mobilize more investment into infrastructure. And we're trying to provide the tools to do that, but we need to work with policymakers on setting up those markets that enable the private sector to actually internalize those benefits that they're getting from investing in infrastructure. And I think that's a key opportunity there that we need to be seeking. If we go on to the next slide then. So again, and this was mentioned earlier as well, that what we're seeing globally is a real reshaping of global financial markets. We're seeing that climate risks are beginning to be priced in, and we're seeing huge financing seeking these sort of green opportunities. So again, there's a huge opportunity there. And I think what we're now seeing around the world is the pricing in of physical risk for the first time. And I've got an example here, is one that people often use from BlackRock, looking at the pricing of physical risk within municipal bonds, for example, in the US. So you can see it now in the pricing. And when we see this being priced in, then you get, again, this additional incentive to make these investments. But we're seeing huge increases in demand, huge increases in for various types of both sovereign and project level financing instruments. So huge innovation in this space. And one of the key questions we need to think about, and we're thinking about in my institution, is how do we make this work for adaptation? And it is working for adaptation. So, I've shown here an example of the Netherlands' recent green bond, which was heavily based on adaptation. So these instruments are coming to the market, and I think more support can really help to accelerate this area. Go to the next slide, please. But I think that the session outline talks about what are the barriers to resilient infrastructure and how do we overcome those. I think actually, from all of the discussions that we've had, actually the resilience part is not necessarily the problem. It's the financing of infrastructure. When we talk to infrastructure investors, actually the making it resilient is kind of the easy bit. And there are issues around data, but uncertainty is not a barrier, I would argue. I've been working on this for 20 years. It's really about how do you mobilize investment in infrastructure. And if we go to the next slide, really, while we're talking here about the role of the private sector and the importance of the private sector in catalyzing investment, it also needs the public sector. So we need the public sector to create the enabling environment to do this. This is a very complicated diagram, basically a theory of change for how you mobilize finance into infrastructure and the role of the public sector. But it just illustrates that the public sector has many roles to play. So, down to roles in terms of fiscal policy, setting the right fiscal policy environment, setting the right sectoral regulatory environment, supporting where needed through subsidies programs, ensuring appropriate disclosure regimes, supporting public goods in data. So all around the private sector, these public sector interventions need to happen. And I think really need to be happening at scale, because when you look at, a particular country, so I've just been looking at the UK, for example, and we've also done some work in Mexico and other countries. Actually, you often see that a number of these different public sector interventions are missing or too weak, and they're not creating that enabling environment. We go to the next slide. And certainly when you look around the world at what's happening in terms of global financing facilities for infrastructure, you really see that there are huge gaps in our global architecture that is supporting this area. There are gaps in terms of the investment in public goods. There are gaps in terms of technical assistance. One of the key gaps that really surprised me is looking, for example, at our various blended finance infrastructure facilities. How few really have significant resilient infrastructure projects? So why are we not integrating resilience into this existing infrastructure financing facility? And do we need new types of cooperation? So, should we learn, for example, from the JETP programs that have been really successful on the transition finance side, and do something similar for resilient infrastructure and adaptation? For example, like a JADAP-P. So I think there are new models that we should be looking at that bring together both public and private sector to really create the enabling environment and unlock finance. I think there are significant opportunities here. We go to the next slide, please. So I'm just going to finish up on some thoughts on data and metrics, which is a really important part of this as well. And I would argue that to overcome the adaptation finance gap, we have to address the data gap. For investors, getting that basic data on where the opportunities are, where the risks are, is very important. It's very, very difficult at the moment, particularly if you're in emerging and developing economies where there are data gaps. So one of the initiatives that I'm involved in running on this in collaboration with the CDRI is the Global Resilience Index Initiative. And this is a collaborative initiative that brings together all of the best available open data and puts it on one platform to enable the investment community, as well as MDBs, DFIs, the whole architecture to share a consistent set of information about where the risks are and where the opportunities are. And infrastructure is a key focus for this. If we go to the next slide, please. And one of the key things that we're working on now, and actually this is work supported by the FCDO in the UK, is using that to develop tools to actually assess infrastructure opportunities. So actually to be able to drill in and look at a particular piece of infrastructure and analyze what are the cost benefits of investing in resilience for this particular piece of infrastructure. And this kind of tool, which is made possible through innovations in remote sensing, AI, etc., these kind of tools are now openly available, and we have this running for some countries in the public domain, and hope to be able to do this globally by the end of the year. Next slide, please. As I mentioned, this is the really important part of this is collaboration, trying to look at ways that we can provide data that allows us to calculate these metrics of the societal benefits of investing in resilience. And that's what we're really trying to do. Provide the metrics to support public policymakers and the private sector to be able to really calculate the benefits and look at ways to build markets around that as well. If you go to the next slide, please. And then my final point is around nature-based solutions. I know when we talk about infrastructure, we often think about the hard infrastructure, but just to note the huge opportunities on nature-based solutions. So this is just some global mapping that we've done at Oxford, looking at coastal green infrastructure, so mangroves, for example, and where investment opportunities are on that side. Again, huge markets being developed around this area at the moment, globally linked to carbon markets, but also some growing biodiversity markets as well. So again, a huge opportunity there. So I'll finish there. It's been really lovely to talk to you. I hope that this sort of opportunity framing helps to inspire some great discussion, and thank you again for the opportunity to be here.
Thank you very much, Dr. Ranger, for a very excellent and comprehensive presentation, which really sets the scene for the various questions that I'm now going to ask my panelists to address. The first question, and I should add that I will turn over to panelists, but at the end of each question, I will also open the floor to the audience, and so anyone who would like to contribute or indeed ask a questions will be welcome to do so. So the first topic we want to cover, building in some ways on the point that was just made about the need to have more data on resilience, is to ask some of my panelists whether actually how can investment in disaster risk reduction be made more attractive to the private sector? Is it largely a question of data or not? How does risk how is risk being taken into account? How is it remunerated? After all, if you're a private sector investor, you want to have a return on your investment. So how do we address that? And with me to cover the topic, we have 5 panelists, and please excuse me for some of the pronunciation. Dr. Ila Patnaik, who is the chief economist of the Aditya Birla Group. Do we have Mr. Patnaik? Right, sorry, Mrs. Sorry. Mr. Rajendra Ratnu, who is the executive director of the National Institute of Disaster Management. Hello, thank you. Mr. Pankaj Sindwani, who is the chief business officer of Tata Cleantech Capital. I saw Pankaj earlier. Hello, welcome. Mr. Pankaj Tomar, who is the India head of AXA Climate. Hello. and Mr. Pratik Agarwal, who's the Managing Director of Sterlite Power. Hello, very nice to meet you. So if I can perhaps turn to you first, Dr. Beitneig, to have your thoughts on this issue of investing in disaster risk reduction for the private sector and what's needed.
To be here. A lot of the discussion that happens on public-private partnership in the space of how we can improve infrastructure in terms of its resilience is often the private sector asking for more information. So it is information about where it is better to invest. It could be locational. It is information about changing risks, the changing environment, and particularly now when we are seeing disaster risk increase more, and of course, early warning and what the private sector can get. I think what is very pertinent is the topic that is being discussed today, which both Kamal talked about and Nicola talked about, which is how do we create a market for resilient investment? And that's the thing that I would like to focus on. To start at the beginning, why is there no market? Because there's a market failure. I mean, fundamentally, when the private sector invests, it does so sometimes not even fully taking into account it's the risk that is even internalized because of myopia. We often discount the future very heavily. Second, it doesn't take into account some of the externalities that get created if it was to fail, even operational failure. So, say in telecom, or so those externalities are much wider than what the private company is willing to even look at. Which takes me to the fundamental point that if the problem is one of information asymmetry, as we economists like to call it, then can we start looking for solutions also by improving information? We need to make the owners care. After all, today, if they have to bear a cost, and that cost is, doesn't matter. It's just that it will make you less competitive than the others if all was normal and if there was no disaster and there was no event that made things go bad. So, you tend to not put that money in place. So I think we can, as Nicola did point out, turn to the climate space in terms of looking at how today investors care. So when investors put money into green finance or when they look at the ESG scores of companies, today, there is an awareness that they care. There are ways of measuring green. Of course, it's still not all settled because there are many ways and there's a lot of confusion, but we are on track on that. So I think my first thought would be that can we start doing this far more actively so that people in the private sector, in companies like, for example, in India, where the bulk of the new infrastructure in the world is going to be built, start caring much more than they are caring today. It has to show up in the valuation. Owners will care when it shows up in their valuation. They are not going to put money down unless they can see the benefits in monetary terms. So the private sector, let's be clear, cannot be expected to do things out of the goodness of their hearts. Governments are expected to do things because they are there to provide public goods, but the private sector is not. And I think that is the beginning of the discussion that we need to have with perhaps trying to measure, rank, have halls of fame and shame so that those who are putting their own people as well as society at risk should actually see a negative impact on their valuation because of what they are not doing. And unless that relationship between their valuation and the decisions that take becomes clear, they are not going to turn around and ask their managers and their plant heads to put in more safety, because all that costs money. And as long as we're going to be focused on cash in, cash out, as long as we're going to be focused on quarterly profits, I mean, we have a, whether it's India, and I'm emphasizing India because I'm coming from the Indian private sector, but I'm sure it happens all over the place. But where the emphasis is on profits and quarterly profits, maximum annual profits, owners are not going to care, and the managers are actually going to cut costs. And so that needs to change. I mean, that's the first thing that needs to change. And that has to come from disclosures, measurement, rankings, and later, I think, we should start thinking about more stringent regulation, where it can be bans or it can be, the regulator demanding something. Because when we go to that level, state capacity is very, very limited. For the government to go in and check something is very, very limited. So you want lenders to care, you want investors to care, you want owners to care. So those are my brief remarks. Thank you.
Thank you very much. Very comprehensive introduction to the topic, and I think you hit the nail on the head, namely, it has to be reflected in asset valuation. And at the moment, that connection between resilience and asset valuation is very difficult to make in most cases, at least within the context of a private sector investment. May I now turn to Mr. Ratnu for his thoughts, please?
Thank you very much for this opportunity. In addition to what Kamal told about the 2 or 3 dimensions of the private sector towards resilience, I'd like to add yet another dimension that not only private sector, for that matter, the entire economy is major sectors that today are the biggest reason for emissions. I think those sectors, even World Economic Forum has identified 7 such sectors, and how faster they move towards greener energy transition also will be bringing more resilience in long term as a mitigation strategy for climate action, proactive climate action. Coming back to the limited context of the DRR, I like to share in response to the first presentation which was made regarding that how more resilience can be built into the infrastructure. So the Indian example of where I was associated from the beginning and this major policy decision of Indian government, that was about Prime Minister's program, National Master Plan for Multimodal Connectivity. This program has actually evolved 2 major pillars. One is on data and GIS information technology enabled, where 1,500 GIS layers have been gathered. And second is the mandating that 500 crore and above infrastructure investment from the public sector will necessarily be scrutinized by the technological platform as well as the governance structure, which is mandated by cabinet. And this governance structure has, one is a policy making structure which gives from time to time guidelines that is headed by cabinet secretary called EGOS, empowered group of secretaries. And at the functional level, there is a network planning group which is heads of all the infrastructure ministries, their technical heads. Any project that is, the silos are broken and integrated and holistic analysis of these projects is done from the last mile connectivity, multi-modal connectivity, but at the level of the planning itself, since these data layers are available. For example, if a highway is passing through a reserve forest or that thing, the the platform is able to throw the options, the alternative options by which you can optimize your economic resources as well as minimize the risk. So this is a transformative tool which Indian government has implemented, and I think there is a lot to learn from these experiences of this thing. Yet, this has to be taken to next level. Perhaps what is being talked about, the resilient indexing and other parameters, I think can be evolved. Regarding the sharing of information with the private sector, this is under discussion and debate within the government, and some decision will be soon taken in what manner and what regulated manner it can be shared. So this is something which I thought I'd like to share. As a National Institute of Disaster Management, we are creating a knowledge network across the country of the universities and academia, which can be leveraged by the private sector as well as the government, other infrastructure ministries, so that this disconnect between the infrastructure developers and the academia can be bridged. Thank you.
Thank you very much. Indeed, also very informative and complements very nicely what we've heard about the need to have access to data. So I think this is where government and academia play a leading role in ensuring that the private sector can be properly informed. Let me now turn to Mr. Sinwani to ask him to tell us how Tata Cleantech Capital look at this issue.
So I would like to first address the issue of private investments in the climate resilient infrastructure. And to my mind, it is not so much an issue of finance. To me, finance is a derivative. Only if you're able to resolve the issues around availability of finance, finance will follow. So what you need to have is a conducive framework. What you need to have is a conducive policy environment, and then finance will follow. And there are so many parallels that we can draw within India. For instance, National Solar Mission. When it was launched, there were similar apprehensions around availability of finance. And today, the fact is that finance is chasing those projects. Renewables is one example, transmission is another example, roads is the third example. So only if you invest beforehand in the PPP framework, in the right assessments of the risks, it is possible for you to attract private investments. And what we really need to do for climate resilient infrastructure is first to have some kind of a regulation. Unfortunately, today, the entire regulation is centered around disaster resilience and not so much about climate resilience. And that first needs to change. And second, climate resilience needs to be closely embedded in all the new infrastructure that is getting built, right? That's so very important. And once that gets built, you need to then identify where are the gaps. Do we have any viability gaps because of this resilience being embedded into the infrastructure projects? India's infrastructure is yet to be built. Almost 60–70% of infrastructure is yet to be built. And we have this tremendous opportunity to build it more resilient. And the cost of that resilience can be baked in the PPP model, right? That's one. Second, even Reserve Bank of India can play a very important role, where today, unfortunately, climate risk is not something where the central bank incentivizes or disincentivizes the commercial finance institutions, and even the awareness around what can happen to those assets which are being financed by these financial institutions is lacking. So if there is some kind of incentive or disincentive for institutions that are proactively taking care of climate risks in their assessment of projects, that will also work wonderfully well. Second part is incentives. What kind of incentives you can build? So for instance, if a project is being built with resilience in focus, can you give them some kind of a tax rebates or interest rate rebates? Those kind of incentives can work beautifully well. Likewise, as Ila earlier said, shame those who have not been able to, meet those standards, right? It's through disclosures, through transparency. So that kind of negative incentive can also work. We also need to equally work on capacity building. I think this is something which is clearly lacking. Mr. Nishikawa earlier demonstrated how data can be used to make the audience aware. And here, private sector can play such a vital role. If it can happen in Japan, where you could simulate the demand by just sharing the data that much more secularly or much more democratically, it can work wonders. If, for instance, in the city of Mumbai, what can happen 20 years, 30 years down the line to your assets, and what are the alternate avenues of investments available to you. So those kind of dialogues, those kind of discussions, and that kind of transparent information being made available will also help a great deal. Then capacity building can also be done through more intense dialogue between national and subnational governments, including with municipalities, industry associations. And the third is finance. See, finance, till such time that we see some viability gap, can also be addressed through, say, through instruments like blended finance. We are ourselves recipient of money from Green Climate Fund, and we've used that beautifully to, to develop the solar rooftop sector in India, right? Likewise, you can have blended finance facility for sectors like these. Then you can have instruments like concessional finance or first loss risk guarantee, where the gaps are even starker. And the third is, you can have demonstration projects being led by state-owned entities. So in the beginning, let the public sector institutions take that initiative, build those projects, and private sector will feel encouraged to then follow suit, because by that time, you would have had the advantage of someone having already done that, and people will be able to learn from that experience. And lastly, I think institutions such as ours are always keen to fund projects like these. Our issue is finding the project pipeline, finding the pipeline of bankable projects. So long as we can build the pipeline, so long as those projects are bankable, and that can only happen through all those enabling framework issues that I talked about, I think finance will follow. Domestic institutions, global institutions, and multilateral institutions will be more than willing to fund to this sector. Thank you.
Thank you very much. I think we've got the answer to your third question, Kamal, here, in terms of what can the public sector do to incentivize the private sector to deploy capital. I mean, I've noted the need for a conducive framework, incentives that the government needs to provide, and indeed ways to address any viability gap. In some ways, as you pointed out, Mr. Sinwandi, this is mirroring what has happened in India over the past 10, 12 years in the solar sector, and the successes that sector has achieved, and whether that can be directly translated, the lessons learned, to, in some ways, an infrastructure resilient asset class. May I turn to you, Mr. Tomar, to ask you to tell us how the insurance world views this issue and can indeed contribute to mobilizing finance for resilience.
Yeah, so I think if we get to the basic issues of why there is no investment or probably not much encouragement on the adaptation side compared to mitigation, because the returns are not very well understood by the investors when we talk about adaptation per se, because even though there is a concept of resilience dividend, but they require upfront huge cost and then long payback periods. And investors are not really looking at these kind of scenarios. And that is one reason why adaptation or resilience investment is not looked at very, very favorably by private investors. The second problem is around the mainstreaming of climate risk when they do their investment due diligence, because how the project is going to span out in terms of the climate risk with different, say, IPCC scenarios is something which is not clearly inbuilt currently in the investment due diligence process. So that's the second problem. The third problem is, of course, there is a myth or a misconception that adaptation investment will not help you making money, because one, the payback period is very, very high. The returns are not very well understood compared to a mitigation project, like, for example, a renewable energy project. So these are 2-3 fundamental core issues around adaptation is what we have observed globally. But there are a couple of solutions which we have seen in the global markets, and I'll come to insurance later, because that is how that is what we do day in, day out. But before that, I guess climate screening is the starting point for any investor. So while stress test is being recommended by various regulators throughout the globe, but climate screening in true sense will help them quantifying that resilience dividend which is not currently available on the table, and hence there is no encouragement for these kind of investments. Second, I give you a example on the mitigation side. If I let's say if we take a step back, go back 10, 15 years, there was a question mark even on the mitigation also. So if, let's say I give you one example of renewable energy, even though there is a huge investment on the solar and wind, at the same time we see there is a drastic decrease in certain pockets in terms of the availability of solar irradiation or the wind availability. So how insurance industry is helping the investors, so they are basically creating a collateral in terms of if there is not enough sun available or if there is not enough wind available. So it basically creates a collateral for the investors to favorably look at those projects. And we'll have to replicate that model for the adaptation projects as well. Because when we talk about resilience or the adaptation investing, the main issue is that the project itself is prone to climate risk. And that is the first thought which comes to any investor, that even though it's a resilience project, even though it's an adaptation project, but end of the day, the project itself is exposed to climatic features and disasters. So if you can create an insurance program around it, it will increase the bankability of such transactions. And in terms of other solutions, so what we see globally, that blended finance can be the only solution. I mean, we can name it in any manner. We can create a primary layer by public institutions. The private investors can sit on top of it, or we can create such a facility where the adjusted returns are created in such a way that on one hand there are public investors, at the same time the private investors who are expecting a decent rate on return. So blended finance with insurance as a collateral, I guess, should be the good starting point. Having said that, climate mainstreaming, climate screening at the due diligence process is must for any investor. So I guess these are the 2-3 points which come to my mind, given the global experience we have as an organization.
Thank you, and indeed, again, very, very important points. There's a question that's I'm burning to ask you, and I think I will ask you now, which is there evidence in the market of infrastructure assets that have embedded resilience features benefiting from reduced insurance premia as compared to the counter-narrative of projects or assets that may not have the same resilience features? In other words, is the insurance market efficient enough at this stage to incentivize investors to implement resilience features in their projects?
Yes, and we look at it a bit differently, in the sense, if we talk about insurance market, the traditional insurance market, for most of the cases, the market is not well equipped to respond to these situations. And that's where the alternative risk transfer techniques have come into play globally. Parametric insurance is one such solution, and which can be blended along with the overall project so that the bankability increases. So, I mean, there are, of course, several examples across the globe where, let's say there is a fund which is insured, and it comes handy if at all there is a disaster, and the private investors are sitting on top of it. So in that sense, the investment is secured if there are any disaster events. So we can for sure replicate some of those models in India as well.
Thank you very much. Let me turn to Mr. Agarwal from Sterlite Power.
Thank you very much. I'd like to focus on my personal experiences in building electrical infrastructure in emerging markets like India and Brazil, and then operating them for the last 12 years, and the experiences we've had with beyond design climate events and how we dealt with that, right? So drawing back to this. We are in the business of building and operating high voltage transmission lines, primarily to evacuate renewable power from the source to the end consumer. And we do this on a 30-year concession model where we are supposed to build and deliver 99% availability year on year. So obviously, if there is a climate event which is within design specs, then we don't get paid. And we have every incentive to build enough so that it's within design specs. Now, we had many events, but two that I can name. About 7 years ago, one of our projects passed through River Ganges, and the River Ganges changed its course by almost 7 kilometers in one direction, which was completely unprecedented. So we had towers that were meant to be on land, but were basically submerged in the water. And that's something that hadn't happened before. Similarly, we had wind speeds in southeast of India far exceeding the design speeds of about 110 kilometers per hour, and led to some impact on our projects. So if now we come to the solution, what can we do differently? Frankly, I have a bit of a different opinion. I think that PPP projects are best done when there are least number of variables. There are standardized contracts, at least in the emerging markets, where the evaluation cannot be on multiple parameters. You have to evaluate pretty much on 1 or 2 parameters. So you have to standardize. So everybody has to be bidding on the same information. And the information that you build, for example, transmission grids or anything else, is basis a code that's handed to you at time of the tender. Now that code is basis data that is very, very old. So we are talking today about how do you retrofit infrastructure for climate resilience, but I'd like to talk more about the fact that we're building trillions of dollars of new infrastructure as we speak on data that is old and not updated for the fact that there is far more fluctuation and unpredictability in the usual things like wind speeds, flooding, flood levels, seismic areas, compared to we've ever seen before, especially because of climate change. So I would say a simple thing, like using better statistical models to update data, which is then into the construction code, is usually enough. For example, one of our projects was about $150 million transmission line, and we realized that it has been built to the wrong wind specs. When we had to upgrade it to the right wind specs, after enough engineering, it only cost us about $4.5 million to upgrade. It's not a huge amount of money, but if we had the right data, we could do it. So I think in the new world of climate change, the code and the people who write the code have to have a much shorter time frame in which they update the design specs. And I think historically that's done once in 5 or 10 years. It maybe needs to be done every 3 years, given the volatility in climate. And frankly, the payment piece is, it's not difficult. I mean, once it's in the code, everybody's designing for those specifications, and the market takes care of itself, because if you haven't designed for it and there's a collapse, you will not get paid, and you will probably go bankrupt on that project. So in a way, the market takes care of it in that sense. The last thing I'd like to say, perhaps a little opposite to what's been said, is that we also cannot overdo it. For example, the Texas blackout, right? We all know what happened, 48 hours of freezing temperatures and the pipelines froze. And then there were some people who said that, Texas should have hundreds of billions of dollars of grid upgrade. Now, somebody came out with the joke that, just because you had 2 days of freezing weather, would you buy, a feather coat in Texas, right? The answer is you still wouldn't buy a feather coat in Texas because it's 2 out of thousands of days of freezing weather. So I think, money can go in the wrong place, and it's, money is scarce. So we just have to be really careful with the models on where we are spending. And the reality remains that we may have to accept going away from 100% uptime to perhaps 99% uptime. And that 1% uptime can save you a lot of money if you're willing to live with it. So I'm talking of adaptation. And you can't do that in the prime cities in the world, but you can do it in other places. So I'll stop there. Thank you very much.
Thank you very much indeed. You make very interesting observations. One which I wanted to throw open to the floor at some point in this session, which is this notion that resilience perhaps is a relative concept. And what are you aiming to be resilient to? And isn't that evolving over time in a way, sadly, as climate change becomes more significant? Open question, perhaps we'll address that in a few minutes. But let me move on to the second topic here in the interest of time, and then at the end of that second topic, I think we'll open it up for any comments or questions from the audience. The second topic we want to address, which is which follows nicely from what we've just been discussing, is the PPP, public-private partnerships, the extent to which they can leverage the joint capabilities of public and private sectors, the extent to which they can help monetize resilience benefits, and indeed, as we've heard at the beginning, the extent to which they can internalize what are, in many respects, externalities. So to address these topics, we have Ms. Jyoti Bisbey, who is the executive member of the World Association on PPP, based in Washington. We have Professor Satoru Nishikawa, whom we met earlier today, professor at the Disaster Mitigation and Research Center, Nagoya University. We have Mr. Pranav Prashad from the International Labour Organization. Hello, welcome. And then we have Mr. Sorat Suneja virtually from the National Investment and Infrastructure Fund. Perhaps, Mr. Suneja, I will give you the floor first, given that you've been waiting for quite some time, if indeed you're with us virtually.
Yes, I am. Unfortunately, hear me.
We can. You're breaking up a bit. Well, why don't we?
Or so I will keep my number.
No, we can't quite hear you.
If this is any better, I'll continue. Otherwise,
let maybe while we.
Don't worry. Why don't you circle back to me after a bit?
Okay, very good. So, Jyoti, why don't we start with you, please?
All right, thank you. Thank you, Alexander, and thank you to everyone. And it's really great to be here. So I think I think many things have been said, and I agree with so many things here. And obviously, you know, I want to put my perspective on these things. So 3 points, right? So most of the investments in emerging markets, especially, are financed by the public sector. It's not the private sector, and the DFIs, which is actually channeled through the public sector, they constitute very, very little. 90% of financing today goes to climate mitigation, not to adaptation, only 10%. So, and some of the speakers have already said the evidence in terms of the return on investment on adaptation financing is not there. So it's very hard to really realize what is the rate of return on private financing on climate adaptation and resilience projects. So one of the ways I think climate and disaster risk is a mainstream issue, and I think this is what we are all saying, and we want to really incorporate systemically. So it's garbage in, garbage out, or we can actually start from the beginning where the public investments are actually screened right at the level of Ministry of Finance, Ministry of Planning, Ministry of Development, and the PPP units, which are the main points of entry for public investments. So why don't we all start thinking about including climate and disaster risk screening of all the projects, so that the projects which are in the pipeline for public investments, for PPPs, and eventually which get retrofitted are actually being screened right at the beginning. So, and I think that has to be systemically done at the national level, at the subnational level, including the state-owned entities. In the emerging markets, actually, SOEs are one of the biggest investors. And at the local level, localization, which is one of the recommendations of the working group. The second point is, and actually goes to some of the speakers which I've already said, it's very hard to prove the return on investment, rate of return on climate adaptation projects. And one of the things of which the International Sustainability and Resilience Center, of which I am part of, this is a small startup NGO, we are trying to do is take the analysis, the AI and the GIS-based analysis of forecasting and estimating what is the impact of a disaster happening in a particular city, to taking that analysis and seeing what is the investment, what are the cost savings in the future, and bringing the net present value to today and calculating the rate of return for the private sector. And that, again, has to be done at the policy and the planning level. If the private sector is able to understand that this is the amount, this is the investment I need to make, and these are the benefits which I will, co-benefits and direct benefits, which I will bring to that particular investment, the public sector is also willing to make those adjustments. And the financing also has to turn. Catastrophe bonds, for example, the bet is that the disaster will not happen. Resilience projects can be structured in a way where incentives are made to the private sector that if you build it today, the incentive is for the disaster not to happen or to happen, so that the private sector builds it in a fashion which is more resilient. And if the disaster happens, then they make a payment. Then they get a payment from the public sector. So the incentive has to be built, and this is what I think has to be operationalized in real terms when we say that don't consider it as a cost, but consider it as an opportunity. The third point is the private sector hates the word risk. Disaster, risk, climate, it's an uncertainty. It doesn't work. It doesn't work. What is real is uncertainty. What is real is the contingency, which is built into the contract. So the contract, as a PPP contract, it has to build in the flexibility that something is going to happen, which has not been estimated, has not been incorporated in the contract today, in the financial model today, in the pricing today when it was bid out. So the flexibility in the contracts, these PPP contracts are generally, they're long-term. They're 20 years, 30 years, 40 years. So there's no way to really predict how this is going to impact the rate of return to the private sector. But the contract has to be flexible, and both the parties have to be in agreement that when things will happen, both the parties will come to the table and renegotiate in terms of how we can move together forward. So those are the 3 points I will leave you with.
Thank you so much. Not a cost, but an opportunity. We need to change the narrative in some ways. And I think your last point about flexible contracts, given the maturity of these projects, is indeed very important. Thank you. I'm sure we'll come back to that in some of the comments. I've been asked to give the floor to one of our panelists who needs to leave shortly, Mr. Akhilesh Srivastava, who is the Roads Safety Ambassador with the International Road Federation and chairman of the Bitumen India Forum. Mr. Srivastava, the floor is yours.
Yeah, thanks again. I'm sorry I'm coming in between because I have to leave. There were couple of points which I wanted to make over here. Though my talk was on the encouraging the emerging market companies to include risk resilience or the metrics, how we are going to. What I propose over here is we tried one of the projects through World Economic Forum and in Bitumen India Forum, when we are trying to predict the what will be the best price to buy bitumen, what should be storage. That's called spillover effect, where if the risk matrix is made in such a way that the building is infrastructure built is a resilient, it's going to save money, and if this money can be passed on as a spillover effect to the private company which is building it, apart from all other things, there's a good incentive to the companies to invest into it. Second thing is the contract, the risk, the appetite of risk, whatever we say about the private company, they are risk averse. They're not going to invest money if there is a risk on the front of it. So how we are going to mitigate it? Here the government regulation has to come, the codes has to be made, the matrix has to be frozen by the government so that there is a level playing field for all the private companies or the infrastructure companies who are going to build it. So these are the two important points which I wanted to highlight, considering I am barging into the time, so I won't be taking much time. But the spillover effect, I can elaborate it subsequently also. This is one of the best way for these building the resilient structure, because it gives a long-term effect at the lowest capital investment at the beginning. Yeah. Thanks, Aline. Back to you.
Thank you. I think that's a very important point that touches on some of the comments that we had earlier this afternoon around the multiplier effect of investing in resilience for the benefit of the wider economy and society. Thank you indeed. Let me turn to Professor Nishikawa.
Thank you. Now, I'd like to provide two real examples of successful PPP ex-ante investment incentives. One is a very small local bank. It's actually a local credit union in downtown Tokyo. The name is Saikyo Credit Union. They are located in downtown Tokyo, where there are so many, the population is dense, so many factories, shops, and it's a mixture of the residential area and the commercial area. Now, Tokyo, back in 1923, it was devastated by a big earthquake. Half of Tokyo burnt down. And everybody knows about that historical fact. Now, the president of this local credit union noticed that if there is to be a big disaster in downtown Tokyo, his local credit union would go out of business because the customers will disappear. And he wanted to avoid such bad scenario. So he thought he should take some initiative. So he proposed that this local credit union provide a very special low-interest loan to the local shops, SMEs, small factories, and warehouses that if they do seismic retrofitting or fire safety improvement, they would be eligible for a very special low-interest loan. And he proposed this idea to the Tokyo Metropolitan Government that if you want to protect the Tokyo's local economy against future disasters, that would be the benefit for the Tokyo Metropolitan Government as well. And he was successful in persuading both the local Tokyo Metropolitan Government, and also he made, I would say, a good design of this special low-interest loan. Now, his area of operation is limited because the local credit unions, they cannot fly out of their area of their business. So now, with this new special low-interest loan, it attracted quite good attention of the local SMEs. And that led to the success of this special low-interest loan. So it's ex-ante investment with incentives. The reason behind that it was successful, that people in Tokyo have the very distant memory of the 1923 devastating earthquake. So there's a value in the culture of prevention. That's one case. Another is by the Development Bank of Japan. When I was the director for disaster preparedness in the cabinet office, I formulated the Japanese business continuity guideline. And being in the government, I knew that it's not enough for the government to just make a guideline for the business continuity of big businesses. I knew that there has to be some kind of an incentive to be accepted by the big businesses in Japan. So I negotiated with the Minister of Finance that let us ask the Development Bank of Japan, which is a government-affiliated bank, that they provide a very special low-interest loan to big companies who wish to invest for disaster resilience and their business continuity. And based on the guideline that I provided, there would be screening of the functions, I would say, the program of that big company. And if they pass this, I would say, this certain criteria, they would be eligible for special low-interest loan. But nowadays, in Japan, the interest itself, it's not so high. The actual monetary benefit of such special low-interest loan is not so big. But the Development Bank of Japan made a very good initiative. That is that whenever they grant this special low-interest loan, they make a press release to the Nikkei newspaper, which is equivalent to the, I would say, the Financial Times. Now, every time this special low-interest loan is granted to a big company, it appears on the headline of a financial newspaper. And that makes that it's a good reputation for the recipient company that they are reliable and they are ready for future risks. And that makes this special low-interest loan by DBJ be very popular, that many companies are now asking to be certified for such special low-interest loan. A good reputation. And both of these are based on the fact that the general public and the business community places value on the culture of prevention. Thank you.
Thank you indeed. Perhaps these loans could be coined a resilience-linked loan in the same way that there are sustainability-linked loans, and ensure that the benefits of resilience are priced in the cost of capital. But indeed, very interesting examples. Thank you. Let me turn to Mr. Prashad from the ILO.
Thank you. I'd like to build on some of the discussions that we've been having and the elegantly produced changing the narrative theme that ma'am has already initiated, and choose some examples from the insurance world on how the challenges and the success factors around the public-private partnerships have come into play, and pick up the story from where we talked yesterday about cars and brakes. After that, I was asked a question on what's the role of the clutch, and I think that's exactly where the government comes in. The clutch keeps the vehicle on when the brake is doing its job, and that's exactly where I think the private sector needs to look at the entire partnerships with governments to ensure that value is created for both sides of the story, the governments in carrying out public policy initiatives, and the private sector from creating a sustainable business model for it. It needs to work as an equal partnership. It needs to work with a mechanism where pathways need to be defined very early in the process and not at a time when they say, oh, let's start something and see it happens. But just to pull back slightly, however well the mechanisms can be worked in, and I think all of us who are here at the end of day 2 need to think about it is that a lot of our discussion, in fact, most of our discussion, is featuring around the supply side of the story. So people who will create products, people who will create finance, people who will provide incentives. We need to keep in mind the demand side of the story about for whom are we doing it. Is it for vulnerable households and communities? Is it for MSMEs, micro and small and medium enterprises? Is it for institutions? Or are these partnerships helping the government? So whether it is at the micro, meso, or at the macro level. Having said that, of ensuring that we are able to engage with the demand side, I think in public-private partnerships, the role for the civil society becomes important because they are the ones who are in direct touch with the beneficiaries for whom all these products and services are being envisaged and for whom they are being created. So it's better that they are also on the table for the discussions at the very starting of the process. And that's where I think, ma'am, your NGOs will come and play an important role there. We are actually currently in India where we've had very large schemes that have been developed by the governments and being actually implemented by the private sector. So whether we talk of the Rashtriya Swasthya Bima Yojana, which actually started the biometric trend in the country way back in 2008, now evolved into Ayushman Bharat, of course, or the current crop insurance scheme, the Prime Minister Fasal Bima Yojana, they're kind of game changers in their own way. And they have kind of created awareness and created some kind of excitement around use of financial services to actually help in the current climate change scenarios. So I think the big question on how to scale all these models and the big question around how to ensure that they are used by many more than that is currently envisaged is the importance of how to create awareness around these, around first the availability of these services, and then designing proper processes so that these services become accessible at the point at which they are required. So I think that for any public-private partnership to succeed, there needs to be a huge investment and a huge focus on improving awareness, education, and then aligning the processes to the needs and to the requirements to ensure that there's a seamless acceptance of those services. And this applies to everything that Rowan talked about, whether it's the risk modeling, whether it is the designing of products and the triggers and the parametric stuff that Pankaj mentioned, so that at least the understanding is there, not just at the level of the beneficiaries, but also level of the channels and the communicators and the interlocutors who will actually ensure that these services actually reach the market in that sense of the term. There are global models where people are trying it in these government-supported schemes in addition to India, whether it's the Kenya model of having a pool to carry out the services, or the Rwanda model, Uganda, or Jacinto, we talked about Indonesia yesterday, where the private sector, government-owned organizations do this. But I guess there are effective lessons around creating awareness that needs to be looked at and needs to be developed further. And last but not the least, I think the private sector needs to then look at this. A lot of times, the government is kind of considered a kind of a showstopper at times in time. But it's, I think, for the private sector to ensure that whether it acts as a velvet glove or does it have an iron hand. So I think that's where the adequate understanding and adequate, should I say, interactions have to play a role. And that is where it can ensure that we work like a better, well-oiled machine to ensure that whatever is decided in policy actually gets translated into action in the ground by a better understanding between the private and the public sector. I'll just stop here.
Thank you. It's a vast subject. I think we could spend the rest of the day talking about it because in some ways PPPs are all about risk sharing and allocating risks between public and private sectors. But what we've heard from both of you actually is that that needs to be based on a commonly agreed pathways at the beginning, but it needs to be done in a flexible manner so that things can change and can be accommodated over time. And so how would the private sector accept that? And importantly, lenders to such projects is something that we might want to address separately. Let me come back to Mr. Suneja, if he's still with us, to give him the floor.
I am.
Great.
I wonder if this is any better. May I proceed, please?
Yes, please.
All right. So thank you so much. And once again, my apologies for the interruption. I'll quickly jump into this. See, just as a very brief context, to my understanding and assimilation, one of the central objectives why NIF was created is to be a catalyst for global institutional investors to be able to participate in the infrastructure investment story in India. And I would say that I'll focus my responses on some of the things that during this journey we have observed, happening in India, and kind of what gives us hope. Now, this is a question around public-private partnerships and disaster resilience, and I would fully resonate with what Prateek had talked about PPPs, but I'll kind of take one tentacle of it and see. Essentially, if you're looking at a 30-year or 40-year contract where you are asking the private sector to invest upfront and then depend upon the revenues from that created infrastructure, then you automatically create that linkage or the line of incentive between creation of resilient, including disaster resilient infrastructure, and the long-term, kind of viability of that institution. Because if the infrastructure is not resilient, then you are keeping the financial position of that investment into jeopardy. I'll get into a couple of examples to narrate how at least a long-term focused institutional investor would like to think about factors like this. So we have relatively recently invested into a road tunnel in J&K. And as a institutional investor, what we kind of emphasized on that we would like to dig deep into how does terrain stabilization and landslide protection work for that tunnel? Are we assured of that element of resilience in that construction or not? We then also insisted that as we come in, there has to be a emergency preparedness and response plan, and we would not kind of come in without that being in place. Similarly, we have again made a very recent investment in an airport which is at a coastal location, which has had, a fairly volatile history of flooding. And again, we had insisted that there has to be a flood risk assessment and hydrological modeling that is done, on top of the existing studies, so that we as a long-term minded institutional investors are assured that our investments would be safe. So I would imagine that the natural incentive to think long-term is already there in the PPP code, and therefore probably, for a policymaker, it would be interesting to assess which are the pockets of opportunities where government can, in a way transform itself from a relatively short-term buyer of infrastructure, where this incentive linkage, will have to be enforced in different forms by, let's say, following codes and inspections, to a more PPP-like approach. That's probably one comment, and I'll again reflecting on the recent experiences that we have had with our investments in sustainable energy, maybe I'll leave you with a few encouraging information points in this space, because part of the discussion is focusing there as well. What we are seeing is that actually there are a number of technological solutions that are rapidly evolving to become affordable at scale. So I think the storage, including utility scale batteries and pump storage, is actually kind of becoming a mainstream business. And also low to no intermittence renewable energy projects are now getting bid out at completely commercial basis. So less than a month back, one of our portfolio companies had won a round the clock energy tender at about just over 4 Indian rupees per kilowatt hour, which is a fairly competitive price for non-intermittent firm renewable energy. I remember, I believe it was Pankaj from Tata Clean Tech who had talked about no dearth of money for bankable projects. And again, to resonate to that experience, we have a thriving NBFC business. We have around 30,000 crores of outstanding lending to infrastructure projects, and around 60% of that is in clean energy projects. So, businesses like ours and other private businesses are probably chasing that opportunity that exists within the realm of disaster resilient and sustainable infrastructure. Thank you.
Thank you. Thank you very much. Can I just ask a quick follow-on question, which is, do you undertake a resilient risk assessment in all the projects which you have invested in?
Absolutely.
Good.
See, and see, this is not by some strange code. We have to make sure that our investments will run well for the next 10 years, and we would be able to make exits to people who would appraise these investments for their next 20 years. Yep. There is no other option but to think like that.
Very good. And I think this is a trend in the markets where a lot of the infrastructure investors are now assessing what's called the climate value at risk of their portfolio and working with AXA Climate and various other insurance companies to quantify that. We are slightly behind schedule, and I'm aware that dinner is awaiting us. So what I suggest we do, I don't know, Mr. Chairman, how many more minutes we may have, but maybe let me pause here, open to the floor for perhaps a few questions, and then we'll come back and group the last two questions which we have, and where we have 6 panelists together, including you, Amit. I see you're looking. So are there any urgent question from the floor, please?
Hi, Tom from UNICEF. Firstly, thanks very much for all the contributions. Really interesting to get so many perspectives in such a short time. I think just listening on the way that we're sort of projecting future needs in terms of infrastructure and the way that the data that's being used is quickly outdated, and I hear the need to increase the frequency of updating the building codes, for example. But I wonder, to what extent can we really get ahead of the curve and project the trends, recognizing that indeed by the time today's data is on the table, it's already out of date. Things are accelerating. We know that. That's no longer disputable. So to what point, to what extent can we really project ahead of the curve and plan for the future rather than for today? That's one. And I think that related to infrastructure, but also related to other climate impacts like water scarcity, which is not necessarily only infrastructure, but also leans on social behavior, business practices in terms of water usage, extraction, disposal, these kinds of things. So really how to preserve our resources and regenerate even. So that's one point. The second was, thank you very much for drawing attention to the demand side, not just the supply. I think that's a crucial point. And it was a point also made by others in terms of using the people capital, the social capital. And I think in this respect, yes, awareness and yes, education, but we need to also try to provide a platform for feedback from at-risk and affected communities. They're not always the communities that make such systems financially viable, but they are the systems, they are the people rather, that we have the biggest social and political responsibility to support. So how do we factor that into the equation? Thanks.
Who would like to answer these two very interesting questions? Yeah, please.
Thank you for that question. So I think in terms of PPPs, you know, Mumbai last year went through a climate action assessment with the help of WRI. And I think in all this discussion, we need to keep in mind who controls that risk. Private sector can only control the project-related risk. The systemic risk is still a policy, it's a public policy issue, right? So in terms of, let's say, an area is affected by extreme heat and flash floods, not only that particular project is going to be affected, but the entire infrastructure, the entire system for that city is going to be affected. And that is still a public policy issue. So I think I like to keep it simple. What change you would like to have in the future? And that change is the one which becomes the performance indicator in a contract or in a public policy discussion. And if the change includes social capital, planetary resources, and climate and disaster, or anything which a positive change which you want to see, for example, the particular building has to be built at a certain level so that it doesn't become vulnerable to flash floods, but also it needs to be accessible to disabled people. That is a positive change which you want to bring, and you bring that in public policy and also at the project level. And that's how you bring systemic change, but also at the local.
Sorry. One more question maybe from the audience? Please. Yeah, the floor is yours.
Yes, I thank the G20 presidency and the government of India for having invited Mauritius in this summit. We've heard quite a lot on preparation, mitigation, and preparedness, etc. But one of the things which we haven't really heard of is response, reconstruction, rehabilitation. And then we also have to take in consideration that nature has, as far as Mauritius is concerned, nature has the capacity to bypass all our preparations, contingency plans, by bringing new challenges. We've been focusing a lot on cyclones, we've been on flash floods, but now we are emerging threats like oil spills. We already had one major one with the Wakasho oil spill, which was grounded in the waters of Mauritius. Another threat which is looming ahead is mass evacuation from cruise ship, because Mauritius is becoming a hub, not only by the air, but also by the sea route. And these are the things which we see that we can face in the future. Now, as far as Mauritius is concerned, the public-private partnership isn't really there except when we come to the response. Because when disaster befalls the country, we've got our own National Emergency Operation Command. During this, the National Crisis Committee is going to meet under the chairmanship of the Vice Prime Minister. And in that, apart from the first responders and other stakeholders, we'll also have Business Mauritius, who is going to give all the various facilities just to deal with that. But one of our strong points also is that we also take in consideration our lesson learned. And from that, we have seen that for whatever construction that you're doing, whatever projects that you're doing, you need to have a contingency plan. You need to have your standing order procedures in case there's any disaster. There's lots of things also which have also come forward. For any construction, any building which you're making, we need to do the environment impact assessment. We also make use of the various statistics because we have had huge cyclones. We shouldn't forget that Freddy also, we are lucky that we escaped. But Freddy is one of the worst cyclones which the world has known so far. Even unprecedented in the month of May in Mauritius, there is a cyclone which is looming slightly above, which has never been there. So there's always new challenges which is emerging. So it's also good that as far as response is concerned, we do lack resources. We try to capitalize on the resources which is present with the military. But we also have to take into consideration that the military is there for internal and external security. Disaster management is only part of its mandate. So the major challenge really which the people, you know, when a disaster befalls, they won't really remember what you're doing, what drains you have done. It is how you're going to respond, how you're going to make, to reconstruct and rehabilitate and give them new spaces. If they are land, it is in a landslide prone areas, you've got to ensure that you are going to remove them from that danger area. So according to me, I think for if we deal with a financing of disaster risk reduction, we also have to take in consideration the response, reconstruction, and rehabilitation.
Thank you.
Thank you.
Thank you very much. And indeed, it's a very timely comment because the two next questions we want to address and need to complete this session are firstly looking at the standards and regulations that are required to incentivize private sector to invest in resilience, as well as asking private sector businesses what sort of matrix they think they need. So to combine these two aspects, I'm going to ask firstly Professor Kapil Gupta from IIT Bombay. I don't know if Professor Gupta is here. No. Well, I will then move to you, Rajashree Ray. You're an economic advisor at the Indian Ministry of Environment, Forestry and Climate Change. We have other participants virtual participants whom I will give the floor to. We have Mr. David Carlin, Climate and Sustainability Lead at UNEP FI. We have Dr. Nicola Ranger, who I think has kindly stayed on. And we have Mr. Padmanabhan Raja Jaishankar, the Managing Director of the Indian Infrastructure Finance Company Limited. And last but not least, Mr. Amit Proti, Director General of CDRI. So over to you, Ms. Ray.
Thank you very much. Specifically, I have been asked to address the question of what are the ways to encourage emerging market companies. So, of course, we now heard a lot about the financing, green taxonomy, blended finance and all. So from a government perspective, I would like to put that there are clear directions both from the multilateral agreements level and at the domestic policy level. So there are directions which we can see in the last 8 years or so from the multilateral level through the 2030 Sustainable Agenda, then the Paris Agreement, and the directions need to be factored into the businesses. It provides a direction of travel to the pathway which we need to take. And also, I would like to mention here about the Kigali Amendment to the Montreal Protocol, where there is a agreed phase-down schedule of the HFCs, which also is very relevant for the infrastructure sector, especially for the cold chain and space building sector. So there are directions, there are commitments there, and of course the commitments are taken at the national level, but then is some total of all the private sector and public sector actions put together make that, take our country to kind of, as a country to achieve the targets. And especially on the Paris Agreement, after the Paris Agreement, then if we look at the domestic level, there were NDCs at that point in time, nationally determined contributions, which are the climate commitments. Then there is a cycle which started updation of the NDCs. That is inbuilt into the Paris Agreement itself, that there is a updation cycle where it has to be a progression of your previous efforts. Though every 5 years, those NDCs will be enhanced, which means as a country, those NDCs will be enhanced, and those actions will have to be kind of, that direction has to be taken by the private sector also. So please adhere to those directions, and also from the national level, because the enablers will be taken by the government. And if we look at the for example, the union budgets in the last few years, so there is a kind of mainstreaming. It's no longer in the margins, it's a mainstreaming of green economy and green growth, which is happening at the policy level. For example, the last budget, it talks about green economy in that budget speech 23 times. So that is the kind of mainstreaming which increasingly taking place. Now, another important issue, of course, we have discussed it, that is the cost of capital. So where are the opportunities for reducing the cost of capital? That is what we need to look into it. If we look at the climate finance landscape, there are various kind of estimates and all, but much of the kind of climate relevant finance came from the debt instrument, and much of it, only 16% of it was concessional or low cost capital. So how do we increase that low cost capital financing? There are a lot of role for the private sector investment, but then multilateral development banks need to kind of integrate and increase that share by a factor of perhaps 3, so that the cost of capital can be manageable. So one more point I would like to make here is that about when we develop those pipeline of projects, when we try to do that, there are a few things one can look from a climate perspective. There is a multilateral financial mechanism in place. The representative from Tata Clean Tech said about a solar clean tech project, which was financed by Green Climate Fund, the multilateral, the dedicated climate fund, through a line of credit, highly concessional. So there are opportunities for the multilateral financial mechanism. One has to prepare the project in such a way that there is a strong climate rationale which has to be quantified. So there are opportunities from that space also. One more opportunity I would like to mention here is about the carbon market, both the international voluntary market as well as the compliance market under the Paris Agreement, the Article 6 mechanism it is called. So there is also an opportunity to supplement the finances, and further to talk about adaptation, one can further look into that assess or kind of levy on the proceeds of the carbon credits to put dedicated into the adaptation. That has been done in the compliance market, perhaps in the voluntary market, so the scope can be expanded. Thank you very much.
Thank you very much for this very concise and comprehensive intervention, and indeed important to mention the role of carbon markets, particularly voluntary carbon markets, and the channeling of capital from that market to adaptation and resilience. I'm conscious that we are indeed now late. So let me ask David Carlin, Nicola Ranger, Mr. Jay Shankar to come in, comment virtually, and then I'll turn over to Amit Proti for concluding remarks, if I may. Thank you. David Carlin, thank you so much for having been with us all this time.
Thank you very much. It's been really a fascinating set of discussions on what is a incredibly timely and important topic. And from our position working as a convener of the financial sector, the private financial sector, when it comes to this challenge, especially around adaptation and resiliency, we really need to be pulling all the levers. And it's not just about pulling all the levers, but doing them in a order and with a structure that is going to be effective. And what that means is all of the themes that we've heard about today across how private actors can take steps, how improving transparency and clarity on data, as well as thinking of financial innovations to smooth products from upfront costs with long payback periods to ones that are more investable. All of these topics are relevant, but all of them I really encourage the group to think systematically about and to think in a comprehensive way. What are the government policy incentives within a country that can help crowd in that investment? But also what is, and maybe it's a topic for other sessions, but what is that potential transformative role that DFIs and others in the development finance space can really take on? And I think that to me involves both bringing in private money through being willing to take first loss positions, improving the access and availability of data on projects for private sector institutions, and really thinking about going beyond the demonstration. I think we've had over the last decade plus a ton of really fascinating and exciting demonstration projects, and very few that have been thought of not as a project in itself, but really the first of many. And so that question of scalability, so things like highly preferential rates that are not going to be continued, or specific effort and diligence in one area that is not going to be extensible to multiple projects. Those are things we need to get away from. We've proved the model. We know what to do on a one-off basis. Now it's about bringing it to scale. And that's where, as I said, it's all of the actors moving in concert. Everyone has a role, but it's also how those roles complement each other. So it's an area we'd like to see a lot more work on. We're also, over the coming months, working on a guide for the private sector around adaptation finance and some principles, both around their expectations and responsibilities in that subject. So once again, thank you for having me here, and I'm very eager to hear Dr. Ranger's remarks and those of others as well.
Thank you very much. Dr. Ranger, the floor is yours.
Thank you. And again, let me reiterate David's comments on what a timely and important discussion this has been. It's been fascinating to listen. So I'd like to just come in on the topic of the role of disclosure and regulation. I think the discussion today has really sort of revealed that resolving this issue of how to bring more finance into resilient infrastructure is a multifaceted one, so that there isn't one solution. But on the disclosure regulation side, so particularly financial regulation, I do think there are specific things that we can start doing that would help. So at the moment we see, for example, across jurisdictions that reporting on physical climate risks is way below, way lower than transition risks. So only around sort of 25% of asset managers and asset owners are actually even reporting their physical risk. So there's a long way to go, and I think a couple of tangible things that we can do to make a difference. So one is putting stronger expectations on disclosure of physical risk. And if financial institutions or the big asset owners are required to disclose this physical risk, then they will be asking for this information from infrastructure financiers, infrastructure operators, and it starts to build this risk thinking into the whole system. So that creating that expectation, I think, is really important. Another area that's come up in the discussion is adaptation plans. So, similarly to the discussion on transition plans, a discussion that we should have some sort of way of assessing the credibility of adaptation plans, again, that are disclosed, for example, as part of annual reporting and sustainability reporting. So that can be a really important step, because it requires then infrastructure owners and operators to produce a plan to show how they are building resilience into what they're doing. And then the investment community, the big asset owners, big asset managers, can be incorporating that information when they're making decisions over whether they finance or don't finance an organization, and the sort of costs of capital around that. So that's another really important lever. We find at the moment that the representation of adaptation in the taxonomies that are coming around the world is quite limited. Again, much more limited than on the mitigation side, so much more to do there. And actually, reporting to governments, it can be a really important lever. So in the UK, for example, critical infrastructure providers are required to report under the UK adaptation reporting power. And I think that can be another really important mechanism to encourage disclosure on what they're doing. So again, the investors, the public, government can make informed decisions. And again, I talked earlier about data, and data underpins all of this. This is a really important gap, and particularly for infrastructure. I know CDRI, ourselves at Oxford, and others are really working on that, making available open data around infrastructure risks. So again, there's just a couple of very tangible things that we can do that won't solve the whole problem, but will make a very significant difference and help push capital into areas of resilient infrastructure. Thank you very much.
Thank you. That is a very good way of summing up what needs to happen indeed. Let me give the floor to Mr. Jaishankar, if he is with us virtually from IFCL.
Thank you very much.
Thank you. For
it's been very interesting. I've been listening, and I've been part of the audience as well. I think I completely agree. It's a very, very timely discussion and very important as far as the topic is concerned. IIFCL, if I may just, take a few seconds. We are the financial institution in India, wholly owned by the Government of India, perhaps the only institution which covers financing in almost all the sectors of the infrastructure domain. We have so far financed over 700 public-private partnership projects worth over $150 billion US dollars. And of this covers 17% of India's installed capacities in the power sector, renewable energy of 10% in India's installed capacities, 21% of India's national highway capacities, 33% of India's port capacities, and a number of other airports, metros, and a number of other projects. From our experience, I feel that the world currently faces tremendous shortage of investments in the infrastructure, the possible shortfall of about 15 to 20 billion, 20 trillion US dollars in the estimated worldwide infrastructure demand of about 94 trillion by 2040. I think the disasters, if we have seen the disasters from in the last 2 decades, that's set to increase as per the estimates. A World Bank ADB report says that the disasters are set to increase further over the coming years and decades, as both climate and population patterns change. And as the disasters increase, obviously the larger financing will be needed, and resilience is often seen as or perceived as an undesirable cost by the investors. The upfront cost can be large, that's the perception. But while the upfront cost in actual may be marginally higher, the cost of resilience is small when compared or measured over the life cycle of an asset, infrastructure asset. So I suppose we should be looking at the cost of not creating resilient infrastructure in terms of human loss, property loss, and setback. We should look at the benefits on the other side, and obviously the benefits far outweigh the costs. So I suppose creating resilient infrastructure is a kind of, the kind of strategy that should be, looked at from a very nationalistic perspective. And for this enabling government framework, I would put three major areas where this can be looked at, because public-private partnerships, often look at the third P, that is the partnership, as the main, bondage between the, public and private sectors, which can actually lead to a better and efficient risk allocations, as well as, overall success of any project. So I think the policy landscape for mainstreaming the disaster risks into public and private investments must be ushered in. National governments and regulators need to define sustainable disaster resilient investments, encode risk metrics, and into the broader investments to change investor behavior. And a system to assess the risk in the present and future. I think the role of the infrastructure lenders can be critical in enforcing proper risk assessments and design standards. I think the long-term nature of infrastructure lending implies that the disaster risk needs to be measured and monitored by lenders. And we have been doing that. We have an environment and social safeguard unit, which actually measures and monitors risks. Banking regulators must also require continuous assessment of disaster risks for infrastructure assets on as far as the balance sheet is concerned. So looking at it from a policy landscape, these are I feel these are very, very essential aspects which need to be considered. Strategic planning for infrastructure resilience, an integrated approach adopted at the national level will improve decision making, which is usually the case with climate risks and the impact projections for countries' infrastructure. And resilience-related standards can be developed with a focus ranging between simplicity, enforceability to specificity and adaptability. I think we need to have a regular revisiting of the national infrastructure standards and establishing new norms which are better aligned with projected climate impacts. I think it needs to be a very, very continuous exercise. A lot has been said about the blended finance and a number of other innovative instruments. We have always been at the forefront of innovative financial instruments. The first credit enhancement mechanism and many other such innovations in the financial domain has been ushered in by IFCL. I think in an overall perspective, we have to look at creating infrastructure over the next 30 to 40 years, where the infrastructure created by this generation will get to be facilitated for being enjoyed by the coming generations. So creating it right in the first time is very important. Yeah. And we need to look at the financial aspects with an overall lifetime, over the lifetime of the infrastructure assets, rather than looking at
Thank you.
A very, very specific time. Thank you.
No, thank you. And indeed, you highlight the very significant role of publicly owned infrastructure development or financial institution or investment institution in your case, which I think many of the G20 countries have, but by combining both the national strategy and the investment strategy. Let us conclude by hearing from Amit.
Chair, before you hand over for concluding remarks, can I just request your indulgence for 30 seconds to respond to Tom's question on feedback? 20 seconds starting now. So, Tom, on the feedback thing, it's all about SDG 17 and partnerships in various forms. And that's where I mentioned the issue about starting with need analysis and doing it right at the initial stages and aligning products and processes rather than having solutions chasing a problem later stage. We certainly suggest a seat on the table so that there's a constant feedback rather than course corrections as we go along, so that it remains a constant process. And while Dr. Patnaik will remember the Schumpeterian's perennial gale of creative destruction, we would certainly suggest enough flexibility in the system to take a collective feedback as we go along. I'll just stop here and discuss later. Thank you. Thank you, Chair.
Alex, I think, and thank you everybody. I really first of all want to appreciate, I know all of you have given us a lot of time and we've not given you enough time to speak. And that's not fair on all of you, but such is life sometimes. But what I would like to encourage you is this is a start of a conversation and we're going for dinner. So hopefully this is not the end of the conversation. This is a continuation of the conversation that has started. I will make two very quick points because I was a panelist as well and I had something to say. And I think one thing I want to highlight is there's already a current cost to the private sector. And in a way, the public sector has to start articulating what that cost is. Simple example, the extreme heat in Delhi is costing the construction industry a certain, billions of dollars. And that's in productivity lost because of worker productivity lost. This kind of information needs to be shared with the private sector for them to understand what is the cost that is already something that they're incurring, so they maybe want to do something about it. So that's one. Second part is in the enabling framework, we on the public sector side now need to encourage innovation. A lot of the solutions that we need to address the problems of tomorrow still need to be they may not exist today, or the alternative technologies that we want to promote, such as nature-based solutions, we need to give the space for those to happen, and often we are restricting through our codes and standards very, very limited options for the private sector to innovate. So I think somehow the performance-based codes or other ways of thinking about how do we incentivize the private sector to innovate, because the problems may not even be predictable at this point. So there's just two quick points. A lot has been said about data asymmetry, a lot has been said about reporting risks, incentives, disincentives, demand side, capacity gap. I think I will go back to Dr. Granger's first point, which is how does one appreciate that resilience could be an opportunity and how do we encourage that? With that closing remark, I would love all of you to continue these conversations over dinner. And I again want to thank all of you for your time, because this is an important discussion and we will summarize it and hand it over to the presidency. Thank you.
Thank you. Let me echo these words and thank all of you, panelists and the audience, for a very interesting session indeed. Thank you very much.